get to the word on Wall Street. Top investors watching your money. Joining me right now to talk stocks and investing in this market, Strategic Wealth Partners President and CEO Mark Tepper, UBS Financial Services Private Wealth Advisor Ali McCartney, and Kingsview Wealth Management Chief Investment Officer Scott Martin. Great to see everybody this morning. Welcome and thank you so much for being here. Ali, kicking things off with you. In an important market and an important week, bank earnings in the spotlight this week. Yesterday, we heard from Morgan Stanley reporting a record profit for the full year, capping off a mixed bag for the big banks. Give us your thoughts on what we've seen from the bank earnings so far. Ali, what does that tell you about the macro story?
Good morning, Maria. It's so good to see you back. So you've said it, right? The banks, every earnings season, 4 times a year like clockwork, they kick off the earnings season. And this year, especially this quarter, because of all the angst and the change in narrative about what's the Fed going to do and is the Fed too late, the banks even have more of a spotlight on them. They also have really tough year-over-year comparisons, right? Because if you think about what we were doing a year ago, we were all at home sitting here trading. There was tons of volatility. So what we've seen, with the exception of some of the banks, but some of the really large consumer banks have missed on earnings. The importance of missing on earnings as opposed to missing on revenue is the exact story that we're talking about and everybody's looking to in the economy, which is labor force, inflation, cost pressures, and can you earn more than you have to pay out? That's what a lot of the banks are facing, right? Compensation charges are higher than they've been. And so what that foretells for the rest of the economy in the earnings season is what everybody's looking to.
Yeah, and look, Ali, we heard that from Jamie Dimon last week when he joined me on this program. He said, for the first time in my life, I'm seeing huge pressure on wages and on people. I mean, I thought that was compelling, coming from the chairman and CEO of one of the largest banks in the world, saying the first time in his life he's seeing huge pressure. His word, not mine, huge.
Yeah, so when you talk about the lack of labor force and how we recover not from the pandemic, but how we move to the next chapter of having a robust, retooled labor force so that companies like that run by Jamie Dimon, like those manufacturing companies, can control their costs. That, I think, is exactly what people are looking to, and that is why the market reaction has been so strong.
So Scotty, we're going to get another window into all of this. This morning, we'll get jobless claims and the Philadelphia Federal Reserve, the Philly Fed report out at 8:30 this morning, and then we'll get existing home sales out at 10. All of this in the face of expectations that the Federal Reserve is going to raise interest rates multiple times. We spoke with Satori Fund founder and portfolio manager Dan Niles last week, and he was really ahead of this sell-off. Here's what he told us last Thursday. Watch this.
I think the Fed's going to raise rates 5 to 6 times. I think they're going to start to work down their balance sheet this year. And I think you're going to have 10-year treasuries get close to 3% when all said and done in 2022. And I think that's going to drive a 20% correction in the stock market, the S&P 500, at some point during the year, because I think you're going to see multiples compress a lot.
So, Scotty, we already have the NASDAQ in correction territory, down 10.7% from the highs. Marathon Asset CEO also says he's expecting, get this, 8 interest rate hikes. 8. Your reaction, Scott, what are you expecting?
I'll take the under. Maria, I'll take the under on that, as well as what Dan said, because remember, the Fed tried to do this a few years ago, and it didn't go so well, and they quickly reversed course. This could be the same thing all over again. I liked what you and Ali talked about with regards to cost pressures and things Jamie Dimon said. A lot of the cost pressures that are out there, Maria, are related to supply. Supply of labor, supply of goods, supply of materials. If those things get rectified, the Fed can step out of the way again and let the economy breathe as it should, because the economy is actually slowing down. The rate of inflation, yes, it's still high, is actually slowing at a decreasing rate as well. So therefore, the Fed can kind of still play in this game a little bit. Yes, get rates off the floor, but they don't have to go crazy with 8 interest rate hikes, for example.
Yeah, it's interesting because one of our guests said that yesterday, that they will try raising rates, but the reaction in the markets will not be good. So then they'll take to the sidelines and take a pause again. We'll see. I mean, look where oil is, Scott, okay? $87 a barrel in the price of oil. Would you buy energy-related stocks or buy the commodity? What's your take on that?
We have been, Maria, and we've been buying
Yeah,
commodities and materials as well. Now, the energy situation is probably more related to kind of at least domestic policy out of D.C. But just one quick thing about the Fed, too, Maria, is that the Fed is a very dovish, embodiment right now. So if you're talking about the Fed going all the way hawkish and staying that way, remember the Fed probably is going to stick to their knitting long term and stay dovish as they have been.
Well, Mark, I know you're looking at dips and trying to find opportunities to get in. You like Teladoc and other healthcare names. All these questions, same issues. What do you think? How do you see all of this?
Yes, so we're actually, I mean, right now we're looking to buy quality stocks on the dip, and we owned Teladoc in the past. We booked a good profit on it. We're not in it now, but I'm really starting to look at it, and it looks very interesting here right now. And if I told you I like Teladoc before you looked at the chart, you might possibly think I'm absolutely insane, because it's one of those companies that kind of fits into that Cathie Wood basket of stocks that's been getting absolutely hammered. But after you look at the chart, here's what you'd see. You'd see that in January of 2020, pre-COVID, this stock was over $100 a share. And today it's below that. It's around $75 a share. And we all know telemedicine is the future. It was really an incredibly slow grind from traditional medicine towards telemedicine before COVID struck, but then it accelerated super fast, probably transitioned a decade's worth of change in a few months. More and more people are doing e-visits now. So when I look at Teladoc, 25% lower than it was pre-pandemic, I feel like I'm able to get all of that transition that happened during the pandemic for free. So I've got a heck of a lot of margin of safety. Could Teladoc go lower? Absolutely. It could be $65 next week. It could be $55 the week after. But if I'm confident that at $75, it's going to be at least $150, whether it's 3 years or 5 years from today, that's a risk worth taking.
Well, I like the fact that you're looking at places to hide, even if we do have a broad sell-off, and it seems like this is an area that has a long runway. Mark, how many hikes are you expecting in terms of the Fed?
So if I'm looking at the Fed funds future, what they're telegraphing a little over 4 right now, I think 4.1. And it's interesting because a week ago, it was 3.5. Yeah. So it's gone from 3.5 to 4.1 over the last week. And what's the S&P done over the same time frame? Down 3%. Yeah. So not looking good.
Yeah, that's a good point. All right, Allie McCartney, Scott Martin, great to see you both. Thank you so much for being here. Mark, you're sticking around.